Welcome back to Investing Talk Podcast.
Today we're looking at Oracle Corporation.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there is a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For years, Oracle has just been, synonymous with the legacy database market.
Right, a huge but kind of slow-moving annuity business.
Exactly. But if you look at the recent numbers, the whole investment story has fundamentally changed. This is all about Oracle's all-in transition into an AI-first cloud operator.
They're really moving past their roots.
Completely. They're not just maintaining what they had, they're trying to buy their way into the future of AI infrastructure.
And it seems like the market is finally starting to notice that acceleration. I mean, we look at the most recent quarter, Q2 of fiscal year 26. Total revenue growth accelerated to 14% year over year. That's $16.1 billion. And the crucial thing to focus on here is that this whole engine is just cloud services now.
The legacy business is just treading water. So that 14%, it's a pure cloud story.
It is.
Exactly. And when you break down the cloud segments, the stability is what really stands out. Cloud revenues overall surged, 34% Q2?
34%.
And the key to their long-term security is that cloud services and license support, which is that stable recurring revenue, that now makes up almost 86% of the company's total revenue.
Which gives them a fantastic foundation of predictable cash flow, even while they're spending like crazy on the future.
Right.
But that recurring base is one thing. The number that really broke through the noise this quarter was that one staggering figure about future business.
We have to talk about the remaining performance obligations, the RPO.
You absolutely have to, because the RPO is the proof. It's the tangible proof that the AI strategy is actually working. In Q2, this figure, which is basically future contracted revenue, it reached an unprecedented $523 billion. $523 billion. Okay, that's a number that needs immediate context. How does that even compare to where they were and what's driving it?
I mean, the size of it is hard to overstate. That $523 billion, it's a 438% jump year over year.
Wow.
And if you look just from last quarter, they added $68 billion in new backlog in one quarter.
That's not just standard software renewals then.
No, not at all. This is almost entirely fueled by these massive multi-billion-dollar, multi-year AI cloud deals. The names you keep hearing are the big AI leaders, Meta, NVIDIA. They're buying up capacity for their training models.
Okay, so if I'm an investor, RPO isn't revenue yet. It's a liability, something they have to deliver. So why does this huge number give everyone such a sense of security about their growth?
Because it provides this unusual, almost unparalleled visibility into near-term growth. These aren't just sales leads. They're legally binding contracts.
Got it.
And because of these long infrastructure deals, management expects about a third, so 33% of that colossal backlog, to be recognized as actual revenue within the next 12 months.
So a huge chunk of next year's growth is already locked in.
It's locked in. And when you have that much certainty on future sales, it makes the heavy spending a lot easier to swallow.
And that visibility is what justifies their ambition, which is all centered on the Oracle Cloud Infrastructure, or OCI. This is the AI factory we hear about.
Yes, OCI is the star of the show here. That segment, the core infrastructure service, its revenue grew 68% year over year in Q2.
68%.
And more importantly, they're not guiding for a slowdown. They're actually guiding for OCI growth to go over 70% for the full fiscal year 26.
So the acceleration is continuing.
It is.
Okay, 70% growth on what's becoming a pretty large base it's incredibly ambitious. Looking longer term, some analysts are painting this picture of just monumental scale.
They are.
We're seeing projections that OCI revenue could go from around $18 billion this year to, $144 billion by 2030?
That is the core investment thesis right there.
That's a transition from a niche cloud player to a true hyperscaler in, less than 5 years.
And it's a thesis built on architectural advantage, not just price. That growth is powered by their specialized AI superclusters. These aren't just big piles of GPUs. They're very specific, highly interconnected computing environments.
Okay, so help us break that down. We see the numbers, scaling up to 131,000 NVIDIA Blackwell GPUs. That's impressive, but why is the architecture the key part?
The architecture is everything in AI training. I mean, when you're training a huge model, you need tens of thousands of GPUs to talk to each other all at once with no delay.
Right.
Oracle's superclusters use a specialized networking tech, something called RDMA, that basically lets the GPUs talk directly to each other, bypassing the slow parts of the system.
So it's just faster.
It's way faster, up to 100 times faster than a traditional cloud network. This high-speed, low-latency fabric is what companies like Meta and NVIDIA are paying top dollar for.
Yeah.
It speeds up their training time and, reduces their costs.
And that's the validation. It's one thing to build it, but it's another to get the top AI firms to actually use it over, say, Microsoft or Amazon.
Well, the validation comes from Oracle's claim that all of the top 5 generative AI models are reportedly running on their cloud.
That is a massive claim.
It is. It suggests that for that very high-performance niche of training foundational models, Oracle Cloud isn't just competitive. It might actually be preferred.
Okay, so we have the backlog, the growth, the tech. Let's pivot to the competitive moat. What makes it sticky for customers beyond just the AI infrastructure?
Well, the first layer of defense is still that mission-critical database and their enterprise apps.
Yeah.
Fusion ERP, NetSuite. These systems run a company's entire back office.
Right, the things you can't just rip out.
Exactly. Oracle is now #1 in that space by revenue. The switching costs are just astronomically high. It's an existential risk for a big company to move their payroll system. That legacy stickiness feeds the cash flow for the AI pivot.
But the really interesting part of the moat now is how they're handling their cloud competition. They aren't just fighting the giants head-on everywhere.
No, they've embraced this really cooperative strategy.
This cloud neutrality thing.
Yeah, and it's genuinely innovative. Instead of forcing customers to move everything to their data centers, they're meeting customers where they are. They're building dozens of multi-cloud data centers literally inside AWS, Azure, and Google Cloud environment.
That sounds almost counterintuitive. Why would you put your best tech inside your competitor's house?
Because it solves the customer's biggest problem, data movement. Enterprises want to use Oracle's database but maybe run analytics on Azure. By embedding their tech, they eliminate the latency and the huge data transfer fees.
It removes the barrier to adoption.
It completely removes
Yeah.
it. They're basically saying, you don't have to leave your favorite cloud to use our best database.
And the numbers on this are just wild. The multi-cloud database business is their fastest growing segment. It reported, 817% year-over-year growth?
817%. It dwarfs everything else. It's the game changer. They've essentially turned their rivals into passive distribution partners.
A brilliant move.
And they're deepening that stickiness on the software layer too, embedding hundreds of new AI agents into their Fusion apps for finance, HR, and so on. It makes it even harder to leave.
Okay, we've covered a really strong bull case. Growth, backlog, tech, the moat. But we have to step back. This level of growth requires an equally massive level of spending. What's the bear case here?
The primary risk, and you cannot ignore this, is the extreme aggression of their capital expenditure plan.
Right.
Building an AI factory big enough to handle that $523 billion backlog is not cheap. Oracle's projecting around $50 billion in CapEx for fiscal 26 alone.
$50 billion in 1 year. Just to put that in perspective, how does that compare to their history?
It's a fundamental change to their business model, which
Okay.
used to be very capital light. I mean, there's spending more on infrastructure in 1 year than they did in the previous 5 years combined.
It's an existential gamble.
It really is a massive front-loaded investment that completely reshapes their financials.
And what's the immediate consequence of that on their financial statements?
Well, the immediate consequence is pressure on profitability. This heavy investment has led analysts to forecast 3 years of potentially negative free cash flow.
Negative free cash flow for 3 years.
Yes. And all that spending requires financing, which means more debt. Some forecasts see their debt climbing towards $200 billion on top of what they already have.
So the bear case is pretty simple then. Can they build all this fast enough to monetize it before the debt load becomes a real problem?
That is the core tension for you as an investor. You're betting that the return from that AI backlog will justify the near-term pain and the rising debt.
A deferred gratification play.
Precisely. You accept the pain now for a massive future gain. The key mitigation, though, is that giant RPO number. They have high certainty that the capacity they're building will be used.
And the legacy business is still throwing off cash.
It is. Operating cash flow is still strong at over $22 billion. That existing cash machine funds the dividend and keeps the lights on while the AI factory is being built.
Let's turn to the stock, because this whole shift has created enormous volatility. The stock surged, 87% year-to-date in 2025 on that initial AI hype?
Yeah.
And then we saw some serious pullbacks when the CapEx numbers came out.
And that volatility has created a fascinating technical setup. Many long-term holders see the recent pullback as a prime accumulation phase.
Right.
Technically, the stock is still supported by that golden cross trend. The 50-day moving average is above the 200-day. It suggests that despite the dips, the underlying long-term uptrend is still intact.
And what about the big money? What's the institutional sentiment during all this concern about cash flow?
They're buying. Institutional sentiment is highly constructive. Large funds are demonstrably increasing their holdings. They're looking past the short-term FCF pressure and betting on the 5-year AI story.
They believe the backlog is real.
Their confidence signals a collective belief that the backlog is reliable and the capacity will be monetized.
So if we're tracking this story, what's the key date we should all be marking on our calendars?
The next major catalyst will be the Q3 FY26 earnings release. That should be around March 2026. And the market is going to be laser-focused on two things.
Okay.
First, sustained OCI growth. They need to show they're moving towards that 70% target. And second, any early signs that all this spending is starting to hit the revenue run rates and improve the free cash flow outlook.
That's when the market decides if the gamble is working.
Exactly. Ultimately, the whole decision here rests on your belief in that RPO figure. Do you believe that $500 billion in contracted AI deals is reliable enough to justify 3 years of negative cash flow and a mountain of debt? It's a colossal bet on Oracle becoming an essential pillar in the future of AI.
Thank you for joining us for this analysis. If you found this discussion valuable, please remember to subscribe before you go.